Cap rate expansion and why even flat exit cap is now an aggressive assumption is the topic we will cover today. And this is really one of the most dangerous cap rate assumptions I see in the current market environment, namely the one that holds flat. I'm seeing different pro formas where the exit matches the going in cap rate, and on the surface, that may look conservative. Many sponsors will tell you it's conservative. 5 years ago, this may have been conservative, but in today's market, it's an aggressive assumption that is hiding inside a spreadsheet. So we'll walk through three signals that I've uncovered in the past few weeks that, taken together, should change how seriously you treat the exit cap rate risks. But before we dive in, my name is Vessi Kapulian, former commercial lender turned investor, entrepreneur, board advisor. Today I work with family offices and their family enterprises at the board level, advising on risk management, due diligence, capital allocation. I work with private investors as well. My passion is also education. So one of my missions is to create educated and empowered investors. And for that reason, I wrote a best-selling book on apartment investing and work with investors on second set of eyes deal reviews, due diligence, so I can help them protect the capital that they are so diligently looking to invest. But I pop in once a week, schedule permitting, to share my thoughts on recent news or relevant topic, or perhaps one that I get a ton of questions about. So if there is a question you're curious about or a topic you'd like to be discussed, put it in the comments or send me a private message, and I'll be happy to take a look at it. So without further ado, let's go ahead and get started. I mentioned that I want to walk through three signals that surfaced in the form of news or discussions I had with investors over the past few days or so, that point to the fact that you should very seriously consider the exit cap rate, and why, in my humble view, a flat exit may not be as conservative as you may think. So number one is a new Hines Research paper that uses the inflationary period between the late 1960s and 1970s as a template for what cap rates might do or how they may behave over the next decade or so. Of course, no one has a crystal ball, and if you'd like a copy of the paper, put a comment below or send me a DM. I'll be happy to share it with you. It's pretty detailed, very data driven. Signal number two that I'll cover in a bit more detail shortly is the April Fed meeting, which produced the highest level of dissent on the Federal Open Market Committee pretty much since the early 90s. And signal number three, if you missed the news regarding federal debt to GDP ratio, it's now sitting roughly at 100% and likely trending higher. Now, none of these are or represent in any way a market call, but together they tell you which assumptions in your underwriting has stopped earning the benefit of the doubt and need to be questioned. So let's start with number one, and that's the Hines Research paper, which is a structural piece. It was written by Josh Scoville and David Steinbach, and frames the cap rate behavior in a way I think every investor should hear, especially in the current environment. Their argument is very data driven, and namely starts with a quiet point that most modern real estate research is built on a data set that begins in the early 1980s, which is not in any way a neutral starting point. It coincides almost exactly with the peak in nominal interest rates and the start of the 40-year disinflationary cycle. So, falling discount rates, rising asset values, falling cap rates, also known as cap rate compression. And that was a very big, powerful, dominant source of returns. In fact, it could hide or mask over any operational inefficiencies. And so, if you see what a different environment looks like, you have to actually go further back, which is why I appreciated the data in that particular paper. So they used cap rate data from the American Council of Life Insurers, one of the few data sets that reaches to the mid 1960s. And so Hines looks at what happened between 1966 and 1981 when US cap rates rose by roughly 510 basis points over that 15-year horizon from roughly 8.3 to 13.4%, which is a striking number. This it was to me, and the shape of the move is actually what piqued my interest. So cap rates did not just rise in a straight line, which a lot of people imply, but they actually rose in phases. They stabilized during periods of monetary easing, and they moved higher again when inflation pressures returned. Inflation pressures returned. The pattern was just, again, not a slope, but a gradual adjustment. And so the investors who got hurt most during that period were not the one who necessarily saw cap rates rise, but the ones who treated the first sign of easing as a durable reversal and build their underwriting and investment strategy around it. And so that path is a lot more relevant than actually the final point. Hines in that paper constructs that what they call an illustrative overlay, and it was not a forecast. They take the shape and the sequence of the 1970s expansion and then applied it to today's starting cap rates, which is pegged around 6%, and a lot of brokerage reports have referenced that number, so there's a lot of public data around it. And so the illustrative path then lifts the cap rates by roughly 185 basis points by 2037, reaching to anywhere to mid to high 7%, with pauses and retracements and retractments along the way. Now, if you do the math for a multifamily syndication, 185 basis points spread over 12 years is around 15 basis points a year. So over a 5-year hold, that's roughly 75 basis points of cap rate expansion, and on a 7-year hold, roughly 100 basis points. So when we talk about conservative underwriting, that's what conservative looks like when anchored to this historical analog and data-driven analog. And here's the part that should change how you read a deal, how you pick apart a deal. In a rising cap rate environment, the valuation expansion stops doing the work, right? Actually, valuations compress, all else equal. Income growth becomes the return engine. Focus on execution and operation is paramount. And so, as Hines puts it, in the 1970s, that period did not reward passive ownership of assets bought at compressed yields. They rewarded the active management, the supply discipline, and durable cash flow. And I'll come to the cash flow point in probably another live event because it's extremely important. Now, I did mention the second signal, which was the April Fed meeting, and the headline was pause A lot of people expected that. The Fed held rates steady at 3.5 to 3.75%. But the story underneath the headlines is actually what's more important, and namely that 4 members dissented. This was the highest level of dissent at the Federal Open Market Committee since the early 90s. And the 4 did not all do the same thing. One wanted a cut, very clear. The other 3 are actually what's more interesting. They agreed with the pause, but objected to including any easing basis or verbiage in the statement. They wanted to preserve the option to hold or even the option to tighten rates if inflation reaccelerates. And that's exactly, going back to the paper, the trap that the Hines Research describes in the 1970s. Cap rates moved higher in phases with pauses in between. The investors who lost money were the ones who read each pause as a no clear signal. Cap rates are starting to compress now. And so the April dissent, at least to me, reading between the lines, was a signal that some of the most trusted members of the Fed, experienced members of the Fed, are explicitly leaning towards higher for longer, with the door deliberately left open in the other direction. And so if your model is quietly assuming SOFR or Treasury rates coming down 100 basis points before your refinance hits, that model has not absorbed what the dissent signal means, what signal that the Federal Market Committee is sending. And so the third signal is one that operators at least want to think about because it is structural and, again, slow and gradual. The federal debt held by the public is now at roughly 100% of GDP, and the Congressional Budget Office projects it will likely continue to climb. I've posted on the topic. There's a ton of content on the topic. Net interest payments now exceed what the government spends on national defense. And why should you care about that as an underwriter or as a multifamily investor? Because cap rates are not necessarily driven by the Fed funds rates, which is short term in nature. They track the long end of the curve, the 10-year treasury, the 30-year, and the long end is increasingly driven by the treasury supply and the credibility of the fiscal policy, and not necessarily goes line in line with the Fed's next move. And so when the federal government is issuing trillions of dollars of new debt every year into a market where foreign buyers have maybe stepped back and the Fed is no longer adding to its holdings, the long end has to clear at a higher yield. Higher long end yields put a floor on the cap rates, not a ceiling, but a floor. And we're seeing that even with the treasury yields today, right, with rising inflation expectations. And so this is not a 2026 or 2027 issue. It's a multi-year structural pressure on the cost of capital that sits underneath every real estate model in the country, where whether you acknowledge it or not, whether the model and the spreadsheet acknowledge it or not. And so of course, the cost of capital is just one driver of cap rates. Interest rates are just one driver of cap rates, not the driver. And we all know correlation doesn't mean causation. So supply and demand for the asset class itself play just as an important of a role. And in multifamily, as we all know, the industry has been working through the largest supply wave in many years. Some markets have absorbed it. Many Sunbelt markets are still struggling through the overhang. And now vacancy is in the 8 to 9% range, again, depending on the market, well above the long-term average. New deliveries are finally tapering. That is the constructive part. I'm sure you're all reading the headlines about the cliff, the drop in supply. But what's also important to remember or think about is the demand side of the equation, because demand has not quite snap back in the way many forecasts initially expected. And so first quarter net absorption was down materially. Job growth has flattened. Household formation is slower than the initial 2024 forecasts assume. And here is where the comparison tying back to the 1970s may get feel or get uncomfortable. 1970s had income growth doing the real work, rents rose with inflation, NOI growth offset some of that cap rate compression. But in today's environment, the pressure is real because the income engine is weaker, right? We're seeing the rent growth negative in many markets or flat for some of the reasons that I shared. And that's really what drives the bottom line. Everything starts from the top line and trickles down to the NOI level, which eventually drives valuation. So the offset to protect returns that was present last time, as that paper outlined, now that may not be available in the current environment. So here is the shift. For most of the last decade of assuming an exit flat cap rate was considered conservative. I actually see that even today. Unfortunately, I even see some sponsors model compression. And even before rates started climbing, a lot of people, I remember distinctly in 2021, a lot of people, even at that time, were assuming further compression from the 4% level. And so they were basically running a hidden bet that the market would continue to remain stronger and stronger at the time of exit. And as we have seen now, that bet has turned out to be very expensive for many, right? Those 4% cap rates no longer exist. And so today's assumption of a flat exit cap rate and forecasting that creates structural pressure on the cost of capital, on reserves, and hinges on the assumption that the supply overhang will resolve cleanly, smoothly, that NOI growth will reaccelerate, that none of the fiscal risk will show up in the long end of the curve. And so these are a lot of assumptions to make in a single number. And so in my humble view, the conservative position now is to model exit cap rate expansion. That's always been my preference, my risk framework, not because anyone is making a market call. I'm certainly not making a market call, but because the asymmetry has changed. The downside, if you're wrong about flat cap rates, is materially larger than the upside if you are right. Again, the NOI component, massive growth, is not there anymore, at least based on the data that we see today. And so just again, remember the math. A 50 basis points move on a property with $1 million of NOI, for example, is roughly $1.5 million swing at an exit value. And that's a difference between the deal returns capital, the deal calls for capital, and if it's not managed right and financed right, potentially loses capital. So what does that mean in practice when you are evaluating a deal? Three things. First, look at the exit cap rate assumption before you look at anything else. If it's flat or compressed relative to where the current market is today, the rest of the model may be sitting on a very weak foundation. Second, ask the sponsor to show you the deal. If they haven't already presented the sensitivity analysis, ask them to show you the exit cap that is at least 50 to 100 basis points above the going in cap, and see how that impacts the return profile. Again, that analogy is very much in line with the paper I shared or commented about earlier during this pop-up live. And if the returns still work, the sponsor, then the sponsor has built real margin of safety. If they don't, then that definitely requires you to take a step back and decide if you're comfortable with that risk profile, with the thin margins, and whether you in terms of how you want to deploy capital. And at least that's my thought process. And then third, look at whether the deal is structured to survive a longer hold, because if a lot of times people may extend, hoping the market environment will change. But if exit cap rates widen, assuming you're deciding to stay longer, um, do the numbers still work? And sometimes the best move is to wait, right? If you have the capital to wait, that can save a deal in many cases. But again, that can only happen if the debt structure, the reserves, the cash flow can carry it. And then, of course, if the principals have sufficient balance sheet to step in and help if and as needed. So, if there's one takeaway I want to leave you with today, it's right the fact that the risk in most deals today is not the going in cap rate, but what's assumed at exit, especially in a thinner margin, a lower growth NOI environment. Conservative used to mean flat. Now conservative means higher exit caps. And the next time a sponsor walks you through their model, the question I would ask is not what their exit cap is, but it's what assumption in the model they're least comfortable defending. And if the exit cap is not on that short list, you have learned something important about how the deal was built. At a minimum, I want to see that they're thinking about it. So really appreciate you joining today. Drop your questions in the comments below, or feel free to message me privately if that feels more comfortable. I encourage you to follow me on LinkedIn, YouTube, subscribe to be notified of future events. And on May 19th, I'm hosting our next investor party. I will put the link in the comments, where we're going to I have an amazing speaker coming in who will talk about fraud and how to detect fraud after the deal closes. Sadly, through some painful and lessons learned that will be very valuable for investors focused on due diligence and protecting the downside. I wish you a beautiful day, and I will see you next week.